Hey, let's get a check now on where investors are putting their money with Gemma Dale from nabtrade, who joins me live at the desk. Gemma, thanks so much for joining us. Look, we have to start with AMP, of course. Sold off today by about 6% on the back of that profit warning. 35% down, I believe, in underlying terms. What sort of action are you expecting to see around that stock today?
So I would expect our investors will be all over it if it comes off hard enough. So last year, AMP was in our top buys, which surprised me enormously. We have a really contrarian investor base. If they think something has underlying quality, when it's sold off they'll buy it. It was also in our top 10 sells, so it wasn't that they were just exclusively buying and holding it. It would have been a long year, I think 2018, if you were only buying AMP. But so there was quite a bit of buying last year when it was sold off heavily. When the price bounced back a bit, our investors were getting out. I think they will do the same thing again today. If they see the price come back hard enough, I'm not sure 5% will be enough for them. If it comes back a bit further, they'll be all over it. But this week we've seen the same thing in Challenger. So huge buying in Challenger, and at an average price of $7.38, so something that would have been on their watch list. They see the price come off a bit and they'll jump in.
There's certainly massive falls with Challenger there. I think about 16% over 2 days. Speaking of falls, I want to move on to ResMed now. Now, the stock currently today is down, I think, 9.5% so far. Now, but of course, that's off the back of an improvement in its underlying revenues and earnings. Do you see similar trading with ResMed on the horizon?
Yeah, I would definitely expect some buying in ResMed. That one is one where they've had a beautiful run for the last couple of years. Investors have seen a high quality company that they have wanted to buy, and when they see the price come off a bit, and as you say, it's not that underlying earnings have fallen off a cliff or it's some dreadful news, just missed expectations a little bit. That's the kind of buying opportunity they really like, and particularly when it's quite a big sell-off, they will be quite enthusiastic about that. So I would expect to see some strong buying today from our investors.
Now, just moving on to Tencent now. They've apparently had 2 games approved in China, so what does that mean?
So this one is really interesting to me. Our investors can buy offshore US, UK, Germany and Hong Kong. So they will buy direct international stocks, and Tencent was the first non-US stock to make it into the top 10. So they're very keen on FANG stocks to begin with, very heavy US buying, and then this real enthusiasm for Asia in general, China in particular, and tech stocks in China. So Tencent was the biggest stock that moved into our top 10 international stocks outside the US. And the biggest challenge for Tencent over the last 12 months is that there was effective ban on the games that they were producing in China. So they sell them everywhere else, but not in China. Concerns from Chinese government about addiction among young players. So this massive issue, 620 million gamers in China. So numbers that blow your mind. So their market is extraordinary. They're the biggest producer of games. They have had, so the prohibition on new games being approved was back in March last year. So there's been quite a long period of time, 10 months now, that nothing's been approved for Tencent. They've been having a bit of a rough run as a result. 2 games approved, but they're small games and they're educational. So they're not the big blow them up, sit there for hours. Okay. This is about craftsmanship and education of children, and quite a different thing. So from a revenue perspective,
presumably though they are approved by the Chinese government.
These are now approved by the Chinese government, right? So they're not that exciting from a revenue perspective, but I think from a sentiment perspective, you will see investors going, okay, the government is softening its stance against this company in this sector, and there may be hopefully some progress on getting the big games where the revenue really sits approved in the future. So I can see our investors getting very excited about that move and taking the opportunity to jump back in.
Just on the Chinese market more broadly, now I think the Shanghai index has fallen by about 25-30% over the last 18 months.
Yeah.
So does that mean now it's cheap, and are you seeing more investors kind of pile in from Australia?
It's been a really interesting thing to observe. So we know our investors have been enthusiastic about diversifying offshore and then diversifying into Asia in particular. So they went to the US first, and now they're going, oh, there's a whole world beyond the US. And that enthusiasm for the Chinese market's been pretty strong. They have seen that fall and watched it with interest. They've been buying into companies in particular, so not buying indices, perhaps the odd fund that's professionally managed, not the index. They've been buying specific companies where they see opportunity, so Tencent, Baidu, JD's been an interesting one because they've had a bit of a rough run and so on. So they've been purchasing those. The one thing we've been saying to them is, can't guarantee you this is going to bounce back anytime soon, but the good news is you didn't buy at the peak. At least you got a bit of a discount on the way through.
Just in terms of the security systems the securities trading systems, I guess, in China. I mean, are they as reliable as ours are here? Are there concerns around that, or people just ignore it?
I think it's challenging for investors to understand that the regulatory environment's very different in a lot of other markets. So when you are used to dealing in Australia, you buy Australian funds, Australian-based ETFs, they're run by global fund managers, very reputable, very well run. We've got a really strong regulatory framework here around markets. To understand that some of the other markets you go into just don't have that, it's a shift. You know, the governance issues are significant. So we only offer the 4 markets. We don't offer all markets that someone may wish to go into. So some of the more or less well-regulated Asian markets, for example, I know our investors would love to get access to them, but the risks are just beyond what they're generally familiar with.
What sort of markets are those, for instance?
Some of the emerging markets, shall we say? We'll just loosely refer to the emerging markets. So our investors will probably go via Hong Kong, or they'll go to the US or Australia and buy a fund manager who's working in those markets or buying an ETF where they're working into those markets. From our perspective, we have a retail investor base that gives us a bit of a security layer that I think is important.
When investors do want to invest in these emerging markets, do they still tend to use kind of general ETFs that have a bit of Russia, a bit of Brazil, a bit of China, or they're actually focusing on the one country now and just getting an ETF that just focuses on that market?
What we have been seeing, which is really interesting, is investors will go to the US ETF market in particular. So the US ETF market is extraordinary. The depth and breadth is incredible relative to the Australian market. So here you can buy a long-only ETF in specific markets, and we do see that. One that I saw that was quite interesting, it's not an emerging market, was Israel. Based out of the UK, so buying an ETF out of the UK over Israel. But we will see buying out of the US specific ETFs in specific markets, and particularly if people want to go short. So if you want to short the Turkish market, for example, they'll buy an ETF out of the US to do that. So people who want really specific plays will buy US to do that.
Now, just in terms of thematic ETFs, so maybe health stocks or mining stocks, are we seeing growth in those, or maybe a shift to to country-based, which I suppose are more diversified?
Yeah, so in Australia, most of our investors prefer to be stock specific. So for healthcare, for example, or in the resources sector specifically, they're very much about single stocks, and they will choose a BHP over Rio, or they're keen on the smaller miners and they will take a position as to which one they think is most likely to do well. So they're very stock specific in Australia. Once they go offshore, we don't see large amounts of sector-specific stuff unless it is by technology, for example. So somewhere where there's quite a range of things where the technology is really complex, it's difficult to pick a winner. So we see biotechnology, AI, there's really tech-heavy areas we will see ETFs coming through, which is quite interesting, buying them in the US. A few of them have been listed in Australia, so robo and bots and those ones have been listed in Australia. They'll buy the Australian-based one as well as the US.
When you say that Australians go to the US to buy these ETFs, presumably the transaction costs are much higher if they're doing it from here rather than from the US.
So the trading costs are exactly the same. So we charge the same for trading costs. Your cost is the FX. So the FX is sort of 60 basis points, and that's the only material cost difference. The ETFs, though, can be much less expensive. So sometimes the trade-off is actually not significant because they're so much cheaper to buy than they would be here if they existed, and many of them don't because of the complexity of what people are looking for.
Okay, we do have to leave it there. Gemma Dale from nabtrade, thank you so much for joining us.
Thank you.